Hello, math fans, or should I call you retirement fans? All right, I put together this video just to kind of talk a little bit about retirement, and I'm hoping that many of you will start saving when you're young, because that is the key to being wealthy when you're older. If you wait for 10 or 20 years and then you start saving when you're 40 years old, it's never necessarily too late to start saving, but it's too late to start making a lot of money. Okay, you can always save money. I could save money for tomorrow, but if you save for 30 years from now or 40 years from now, you'll have a lot of money. But you have to start early. Okay, so one of the first things I say is I'm not an expert. I'm just a math guy, but I like to talk about saving because it's really based on a lot of math. Things tend to grow quickly, and mathematically they grow quickly. Okay. Now the first thing I want to talk about is this website that I have here, the third normal line down here. And I'm going to click on it. Okay. And it's got it's a really good website. I've been using this in class quite often, but it kind of tells you how much you can make based on how much you're saving. All right. And I'm going to put an initial value of the investment as 0 because you're just out of college and you really haven't started saving any money. So let's kind of talk about how much you're going to save. Now, I know it's tough to save, but if you can save right in the beginning, that's where you're better off because then you never miss the money. It's the best time to start saving. So when you get your job, the first thing you do is after you sign all the papers, ask if there's a 401k plan or a 403b if you're working for the government, the state or federal government. It's a 403b. Okay, but if there is, then you want to start participating in that. A lot of times, especially for 401ks, you'll have companies that will match your amount of money that you put into the account. They'll match up to a certain amount. So in other words, maybe if you put $5,000, they'll match that $5,000. That's free money. You definitely want to take advantage of that. There's no reason to not maximize that if somebody's handing you free money. Okay, so you always want to take advantage. Now, I know as an educator, I have a 403b, and Conant doesn't match anything, but it's still a way for me to save money now for the future. Okay, but anyway, let's put an amount in, and it might be too much, it might not be enough, but I'm going to start out with $100 a week. Okay, which is going to be about $5,200 a year. It sounds like a lot of money, but it's really, if you can do that, if you're making $500 a week and you put a fifth of that, that's actually awesome if you can do that. That's kind of a lot of money, though. Maybe you want to put in less. But let's start out with $100, and we're going to do this for a week. And the interest rate, now that can vary. Okay, we're going to talk more about interest rate once we get off of this screen here. But interest rates can vary. They can be really low. They can be negative sometimes. But overall, the interest rate can vary so much. I looked on the internet and I looked at a couple different funds and how long that they paid these amounts of money. Now, the one interesting thing is there was something called a small cap index fund, which is smaller based companies, they're not like the big Intels or Fords. Anyway, I looked at this one fund. It was just a small cap index, I believe, through Vanguard, either Vanguard or Fidelity, which are two good companies. We'll talk about that later too. Anyway, over the past 50 years, so from 1960 to 2010, they have paid an annual rate of 10.08%. So I'm going to use that, 10.08%. And then you don't have to type in any decimal point, to convert in decimal. It actually does it for you. Okay, and then number of years until retirement. We're going to type in, if you start saving when you're 21 years old and you want to save for 30 years when you're 51 years old. And we're going to see how much that amount of money is worth. Okay, so I'm going to hit compute. That is worth over $1 million. Okay, so you can be a millionaire if you invest in some of these funds. And again, maybe you'll make less, and that's on average. You might have a year where you lose money, and then you might have a year where you make 50% on your money. So it all depends. Okay, so it's a risk. Investing is a gamble. Okay, but it's a worthwhile gamble. If you don't gamble, you're not going to make any money. All right. So I want to point out a couple things here. First of all, look at the interest earned. It's $850,637.83. That's how much interest you earn. That means the amount of money by putting $100 in a week, you've put in about $150,000. That's how much. That's if you would have taken that $150,000 and you would have put it in the ground, you would have just $150,000. But by investing it, you made an extra $850,000, which gives you $1 million. Okay, so I want to play with some of these numbers a little bit. That's $100 a week. Obviously, if I double that, which is a lot, if I put 200, what am I going to get? Well, I should get double my money, right? And I do. I get $200 or $2 million. Okay, so the more you put in, the more you're going to get at the end. Now let's go back to put it back to 100. Okay, and let's say our interest rate. Let's actually play with the number of years first. If you saved, instead of saving for 30 years, let's say you only saved for 20 years. Let's say you started saving when you were 40 years old and you wanted to save until you were 60. If I go only 20 years, it goes from $1 million to $334,000. By saving 10 less years, you have made a third of that value. You've lost $670,000 by saving 10 less years. That's a big deal, guys. Okay, and even going to 10 years. I mean, how much are you going to have if you save for 10 years? $89,000. So from 10 years, $89,000. 20 years, $334,000. 30 years, over $1 million. And let's say you saved for an extra 5 years. Watch this. Going from $1 million just for 5 years to $1.7 million. You made $700,000 on that money by saving for an additional 5 years. I don't know if you've heard of the term money makes money. This is the case where money does make money. All right? So an extra $700,000. Let's go 40 years. So we're going from $1.7 million to an extra, so it's, again, another 5 years, you're making an extra $1.1 million. That's huge. The longer you keep it in there, the more you're going to go up. Let's just go, I know you started saving when you're 21 and now you're 61, which is not a bad retirement year. Let's just say you go from 40 to 41 years. One more year. So you go from $2.84 million to $3.15 million. That's $300,000 you can make in 1 year. And that's kind of how it works. The longer you keep it in there, the more money you're going to make. Okay? So you start early, you make a lot of money. Now let's go back to 30 years. Okay, that's our nice little $1 million. This interest rate is actually really key to making money. The banks pay horrible right now. They pay less than 1% interest if you put into a CD, maybe a 1%, maybe a little bit more, but they pay terrible interest. Banks are not the place to save for retirement. It's not a bad place if it's maybe later on in life and you want to save and you want to have a very secure savings and you don't really want anything to fluctuate based on the stock market, then the bank is okay. But there are even better places to put it than the bank, even when the market is not good. Okay, but anyway, this is about a 10% interest. Let's look at what happens if you make it 11%. Now that's going to be just a little bit more than, it's 0.8, so it's about 0.9% more. Look at this. It goes from $1 million, watch this, to $1.2 million. By having an extra percent, I made an extra $200,000. That's a big deal. Okay? So if you put it in the bank and you earn 2% interest, watch this. 2% interest, you have $213,000. Okay? That means you only earn $57,000 in interest. So you put in $150,000 and you earned $57,000. That's nothing. That doesn't keep you up with the cost of inflation. Okay, even 5%. That earns you're at $361,000. You can just see from 5%. People think, oh, well, you go from 5% to 10%, it doubles. It doesn't. It's $361,000 to $989,000. It's almost tripled. Okay, so it doesn't necessarily go up just double if you double the interest, because money. What happens is money builds, compounding they call it. Money builds on itself. So let's go to 15% interest. $3 million. $3 million. Now, I've got a couple other funds here that I looked up, and one was a healthcare fund. And, things happen with every fund, right? With the administration right now, with healthcare being, somewhat nationalized, things change. But anyway, over the past 26 years, healthcare paid 16.26%. So let's put it in there. And if you put in $100 for 30 years, you will have $4.1 million. Okay? Here's another one for you. Precious metals, like gold and silver and platinum, over the past 26 years, it made 19.30% interest. Check this out. Going from $4 million to $8.7 million. All right? So again, it's the same amount of money you're putting in, but look how much more money you've made. Now here's a really extreme. Actually, that was the most extreme that I had found. Okay, and you have something. Here's just something. Energy fund. Okay, so it's natural gas and oil, and this is 12.48. This is for 10 years. Okay, so we're going to compute that. $1.7 million. So you want to diversify your funds, and mutual funds are a good way to go. You diversify, which basically, if something falls, something collapses, you don't get crushed. Your portfolio doesn't get crushed. You actually have a bunch of different stocks or a bunch of different areas you're investing in. And I guess a good example is precious metals. You might have a lot of money in precious metals, and gold is right now, as I'm doing this video, it's over $1,200 an ounce. All right. Not that long ago, gold was $300 and $400 an ounce, and if it happens to decline from $1,200 to $400 next year, you had all your money in precious metals, it would get crushed. So you have a little bit in precious metals, you have a little bit in healthcare, you have a little bit in the energy fund, etc. But the one I gave you initially, the small cap index, that's over 50 years. That's a pretty good long-term fund, and it made a little over 10% interest, which is over $1 million for 30 years. Okay, so that is the deal. You start saving, and you start saving now, and you start investing in mutual funds, and do a little research. Go online, check out these different companies. Vanguard and Fidelity are very excellent companies. They have no load funds, which means you don't pay anything up front. You just buy into their funds, and it's really a good deal. So I would definitely recommend that. All right, so let's go back to my website here. And let's kind of just talk a little bit about some of this. And you can tell as I'm making the video right now, there's nothing here where it says watch my video about long-term investing, but now we're watching it. Okay, start investing with your first paycheck. That's what I told you, right out of college. All right, if you start investing out of college, you're going to be a millionaire when you're 50 years old, and we just showed you that's true. 2 ways to invest for the future. First of all, you should maximize something called your Roth IRA. Now, again, go online, do a little research. The difference between a Roth IRA and a regular IRA is when you start saving money for a regular IRA, let's say you put away $5,000 into an IRA. And let's say you made $50,000 that year. Okay, you're going to be taxed on $50,000. But if you invested in an IRA, or $5,000 of that you invested doesn't get taxed. So instead of being taxed on $50,000, you're only taxed on $45,000. Okay, that's pretty good. That's paying less to the government and saving and forcing yourself to save. Now, a Roth IRA is actually the best bet, especially when you're young and just coming out of college. What a Roth IRA is, you take that $5,000, you invest it in something, in an account, and now when you claim your taxes, you still pay the $50,000, based on your salary of $50,000. You don't have a savings, but what happens is that money grows, that $5,000 grows into an account, and at the end, when you go to take it out, you don't pay tax on it. So, in other words, it'll grow, it'll get bigger and bigger and bigger, and it'll turn into that 1.1 or that $1 million that we just talked about, and then you can start taking that money out tax-free. Okay, you don't have to pay tax on that. So that's what a Roth IRA is. A Roth IRA means you pay taxes now on that money, and a regular IRA you pay taxes at the end. Well, you don't want to pay taxes on the end. A couple reasons why you don't want to pay taxes on the end. First of all, that money has just grown from $5,000 to $1 million. Do you really want to pay tax on the $1 million? Wouldn't you rather pay tax on the $5,000 now? Second of all, you're going to be making $50,000 now, but probably when you go to retire when you're 50 or 60 years old, you're going to be making, I don't know, I'm just going to throw out a number, $200,000, or you're going to be making $500,000, and your tax rate is going to be really, really high. So if you invested in a regular IRA, then you'd have to pay tax at your high rate of tax. But if your income is $200,000 and you're invested in a Roth IRA, that money is tax-free. Okay. Probably another reason too to invest in it is because I think taxes are eventually they're going to start rising. They have to. We have to pay for. I mean, I'm making this video now. We just have our stimulus package where we invested billions and billions and billions of dollars into the economy. We have all the different wars, the Iraq and Afghanistan war, a lot of different things going on, and the only way to pay for this is by increasing tax rates. So if you can pay tax on it now, later on, when the tax rate is higher and higher and higher to pay for all these different things, you're not going to have to pay tax on it, okay? Because you've already paid tax and it's a Roth IRA. So that was kind of a long-winded story, but that is one of the reasons why you want to do that. So truly, that's what you want to invest in first. And I know you want to invest in in your company when you first start your job, but check in a Roth IRA. Because that is what you want to invest in first. After that, you want to, and by the way, and like I said, you can invest in $5,000 after that, or $5,000 into that. After that, you start investing into your 401k or 403b, and currently you can contribute up to $16,500 per year. Now, something I don't have on the website, but ask your employer if you can do a Roth 401k. That's beautiful. If you can do a Roth 401k, then you want to do this first. You want to do number 2 first. Because a Roth 401k means you have the same benefit as the Roth IRA above, but you can invest up to $16,500. So you can keep increasing as time goes on. Okay? So, the next line here, again, I don't want to read this. It's like reading a PowerPoint. I hate reading PowerPoints. You may not be able to maximize your contribution during the first year, but put some money into it. Like here, that's $16,500. For your 401k or $5,000. If you're making a job where you're getting paid $20,000, can you really put in $5,000 of that? Probably not. Maybe you can. All depends on how much your apartment costs, how much your insurance costs, everything. But as much as you can save, that's what you want to do when you're young. That's the time to do it. Okay? But I even said, have your employer deduct the money right out of your paycheck right away. And I even said maybe start with $100, maybe more, maybe less. But this is the deal. Every time you get a raise, put a little bit more money into your retirement account. It doesn't have to be $50. If you get a $100 a week raise, maybe you take $20 and you extra a week and you put it in there. Okay? It makes a big difference, but you gotta, if you can start saving early and start putting more money in, that's awesome. Okay, here's a little hint where you shouldn't invest. The savings account or CDs, that's a bad place to invest. Pay horrible interest. Got another website here about savings account. I'm going to click on it right now. There we go. Okay, it took a little while here. But you can see, these are the interest rates. And I made this video. This is August of 2010. Look at these interest rates. 1.4%, 1.1%, they're horrible. That's the worst place to start saving is with these savings accounts. Now, a CD pays a little bit better, but not a whole heck of a lot better. So here, in fact, here's CD rates. Let's take a look at it. Here, 1-year CD, 1.44%. It's really bad. Okay, so that's just a really, really bad place to save. And checking doesn't pay anything at all. Like going to click on that just for the heck of it. I mean, here 1.1 here. EverBank 0.51%, Ally Bank 0.5%. This is 1.1. That's really bad. Okay, so don't save your money in the bank. It's a bad place. Where you should invest in the stock market. And again, I have two websites here, Vanguard.com and Fidelity.com. So check them out, see what you like, and then start sending money and get they'll be happy to talk with you on the phone and get things set up for you. Okay, they've got a lot of mutual funds, and if you don't know what a mutual fund is, go look it up a little bit. Mutual fund basically is a mix of all kinds of different stocks. So when you have like a energy fund, that means it's got everything from oil, natural gas, all these different companies that have to do with that. Okay, and I didn't list it yet, but I'll eventually put some of the things that I'm investing in just to kind of show you what I'm doing. Okay, a couple more things here, and this video is getting a little long. Just to know, the stock market goes up and down. Don't keep watching it every day or you're going to lose sleep. It's brutal. If you watch it and you go, oh my gosh, the market's down. Oh, it's down again. It's down again. That's horrible. And it even says here, many people panic when the market goes down and then they sell. And many people rush to buy into the market when it's going up. Okay, you don't want to do that. You want to be opposite of that. I'll tell you, when the stock market's going down, it went down really, really bad in 2009. And as opposed to me panicking, well, here's the deal. If you're not ready to retire, it's nice when the market goes down. Because the reason when the market goes down, I buy all my mutual funds at a cheap price. Everything is cheap. That's great. And then when the market goes up, it's going to be worth more money. So it's great when the market goes down. It's bad when the market goes down when you're about to retire, though. That's why you got to be a little savvy. You got to kind of be less aggressive as you get closer to your retirement, because you don't want to be 1 year away from the retirement and all of a sudden your portfolio goes down 50%. You've just lost half of your money. That's bad. Okay, but do a little research. And I even say here, be a steady investor. I even said, I like it when the market goes down because I know I'm buying future mutual funds at a cheaper rate. Okay, last few things. Your other best investment is purchasing a home. And I know some people are saying, well, geez, home prices have gone down a lot and everything. But you know what? You buy a home and you got a steady job to pay your mortgage, but you buy a home, that home is yours. If that home goes down to a penny in value, you're still living in that home and it's still yours. There's still a roof over your head. Okay, if it goes up to $10 million, that's great. You could sell it if you want, do whatever, but it's no matter what, it's still your home. Okay, but always pay your mortgage, always pay your taxes, and you'll be all set. All right? But I said if you maintain your income and your mortgage payments, you'll have your home paid off in 30 years or less, because that's a lot of mortgages are 30 years. Some are 15 years. Got to look for a good interest rate and pay off your mortgage. Okay? But I even wrote here, your home could be reduced to almost nothing, but you still own it. Not like a stock. Okay? If you own a stock, it could go to zero. And I'll tell you, a good example is General Motors. As I'm speaking right now, General Motors had gone bankrupt last year, and they are now in the process of reissuing stock for people to buy stock again. Would I buy General Motors? Actually, I wouldn't, because I don't know what's going on with General Motors. Everyone says, oh, they're making a big profit right now, but you know what? One of the reasons why they're making a big profit is because they're selling a lot of fleet vehicles, and that means they're selling a lot to the government. Well, of course, the government owns General Motors, pretty much. Okay, so the government is buying a lot of their cars from General Motors. It's risky. General Motors may make it. I hope they do, because it's a lot of jobs, but it's a risky stock, and it could go to zero again. Home will never go to zero. Okay, last thing. I learned this from a combination of my grandmother and my uncle. My grandmother lived to 105 years old, and she lived through the Great Depression. She saved money all the time. They never wasted anything. They saved and saved and saved. Okay? So my grandma always said it's important to save money. But my uncle always gave me a little advice. He said, what's money for? It's for spending. That's exactly what it's for. Money's important to save, but your goal is to have a good combination of saving and spending. So that's what I put, a little combination of my Uncle Steve and my grandma. It's important to save money, but it's also important to spend money. And I even said, you have to save for your retirement, but you need to enjoy the years before retirement. There are people that save all their money. They never do anything. They never buy a nice car. They never buy a home or anything. They're never generous to people because they're always saving their money and they're saving for retirement. And there are people that grow old and they are always saving and they die with a lot of money. And that it all goes to somebody else and they didn't enjoy it. So you got to enjoy your money and you got to save your money. You have to have a little balance of both. Because why not enjoy it when you're 20 and 30 and 40 and do different things, go on vacations when you can? Because once you're 70 years old and you got a lot of money, it's pretty tough to go on that that adventure up some mountain and go hiking. You want to do that when you're young. So you got to enjoy those times when you're young, but you also have to plan for when you're older because you want to have good years too. And that's a problem too. If people don't save enough money when you get older, and then you're used to a certain lifestyle and you go to retire, you're making $200,000 a year at a job and you go to retire and now your savings is paying you, $50,000 a year. You got all of a sudden your money's cut in a quarter and you can't enjoy the same lifestyle. So you want to be able to have that same lifestyle. That's why I said you need to have a good balance of saving and spending really to have a good life. All right. So anyway, I hope you guys learned something from this. If you have any questions about saving, I can try to answer them for you. You can always email me. I'll be at Conant High School. Email me at my Conant address here. But again, there's a lot of stuff to read online. If you need any help setting something up or you just want to, talk to somebody, give me a call at Conant or send me an email. I'd love to talk to you and help you out. But I'll tell you, math is important. And I teach math. I've taught it now. This is going to be my 14th year teaching math. And I try to teach my students, whether it's my freshmen or my seniors, how important it is to save for retirement. And I told them it's great to know that the sine of 30 degrees is 1/2. That's just a great thing to know because you need to know it for trigonometry or solve for x or whatever. It's nice to know all that. But if I can get you guys to come out of college, or even if you don't go to college, out in the working world and start saving money, that would be my goal, is to have you guys use some of that math to be financially sound and successful in your life. Okay, I would love it if somebody made a lot of money and they came and gave me a call and said, Mr. Kerfess, I want to pick you up in my new Ferrari. Okay, I would be totally thrilled, and I would ask you if I could drive that Ferrari too. All right, so if you're going to call me, you're going to have to let me drive it too, and hopefully you take me out to a nice meal. Okay? Anyway, I hope you guys are successful in life and you have a good life. Before I end this video, if you're successful in life, make sure you give back to other people. Okay? That's important. It's great to have a lot of money, but you need to help others out too that are not as fortunate as you if you are successful. Okay? Always remember that. Help other people out. Very important. Charity is super important. All right, that's it, math fans and retirement fans. Have a good day. Bye-bye.